Darius Ross joins me here today. You could learn what he's up to by heading over to dariusaross.com. That, of course, is a clickable link in the show notes, but I really appreciate your time here, Darius.
Prayer, thank you so much.
Well, we could jump all over the place because I know you're known for almost anything in this real estate world, but we're going to be tackling some hefty topics here today. But why how did you find your way into real estate?
I got fired from the bank.
Very low kills.
And so from that point forth, his real estate was the name of the game. It was 1984. And fortunately speaking, it was the best thing that could have happened, lay off. And so I got the nickname Junk Man because I would take anything that was junk and put it back together because I'm like, hey, I can do it. At least I thought I could.
You got laid off at a bank. Were you working with clients that had real estate and that's what got your attention? How did that start then?
No, I was working in corporate planning and I was an intern there and I was doing, basically for the books for the board of directors and so forth. So after the company had an attrition there, I had a neighbor that was into real estate and I'm like, I like this, this is kind of different. I liked, as a kid building the Sears Tower, which is right outside me when I'm from Chicago. And I would take boxes and build my towers every single day. I put my G.I. Joes in there and my, Ken and Barbie kind of things and put them in there. So that's how it began, that I like just buildings. Every time I look around, I'd be in an antique place looking at buildings and so forth. So I'm an antique guy that likes old historic buildings.
Sure. So you've kind of worked your way up from that beginnings and humble real estate beginnings to I have seen here now that you are dealing with quite large acquisitions. What are some of the bigger projects you've worked on?
Everything from dealing with multifamily from 20 units to over 1,000 units to at this point dealing almost 100,000 units plus in partnerships, from multifamily to residential to retail to storages to rehabbing small buildings to major buildings. So ground up, it's been a little bit of everything. I've lost my innocence in some cases.
Would you mind sharing what are some of the biggest lessons you've learned along the way?
Trust your instinct, number one. Number two, be very leery of how you actually move around when it comes down to moving your money. Do not spend your money before you have it because a lot of landlords have a tendency to think that, oh, I just bought this building, I can go out and start buying the Escalade and so forth. Lesson number one, stay within your means. The other thing of it is never underestimate a project. If the project's 300,000, figure 600,000 automatically. And never put a timetable on a project. You might be surprised at all times.
That's kind of funny that you bring that up because I have had a tendency of doubling anything that I estimate when it comes to real estate investing just to be safe.
It's utmost of importance because you will lose everything that you have if you're not safe. I mean, that's why a lot of investors now have got themselves into a pickle because right now they underestimated the ROI, they underestimated their income, and now they're in peach.
Yeah, I was going to ask you, being the length of time that you've been in the real estate investing world, have you seen anything similar to the current market conditions?
1987, 1995, 99. See, the real estate market's tricky. Every 10 years you get turbulence, but this time we've gone almost 20 years of no turbulence. Real estate's going to be on sale, not for sale, but on sale because nobody's anticipating the fact that this is not an ordinary market. We have all the divergences of the baby boomers all retiring. We have retail that's all coming to a head where retailers are now abandoning ship. And most importantly speaking, we have a world economy that's now changed. We've never been this far in debt. So we're about to see the kind of real estate nightmare that nobody's ever seen before since the 20s.
Yeah. And I even hate to admit this, but in my own backyard, I'm already seeing some of what you're suggesting. We have brand new buildings, strip malls, for example, that have yet to be occupied. And they were done just prior to the whole COVID thing, and they still sit empty.
We're going to see, I'm estimating it's 50% downside. The stock market's going to take a 75% hit. Real estate market's going to take a less than 50% hit. We're going to be looking at this for 5 years of nightmare, 10 years of turbulence, and ultimately speaking, real estate will return back to 2040, 2050. a long time.
Oh, no. You're predicting some really big number shifts there.
I think people will be watching your show 10 years from now and they'll say, wow, how do you know? Because this is going to be a nightmare. Nobody is seeing how much money has gone into the real estate business. There's no money there.
Well, what do you suggest people do then at this point?
I would say the best thing that can happen right now is for the lenders to start taking the keys back. The banks do not want to be stuck with the keys because on the other side of this, I lived through Resolution Trust, which was in the 1980s, and the savings and loan industry disappeared. I am predicting, and I think I'm pretty right, the banking industry will go from 5,000 banking institutions now to probably down to 1,000 because so many banks will go under because they gave money to projects that were not salvageable. So this is going to be ugly. So what I'm suggesting most investors do now, if you're not over leveraged, they get under leveraged. Give the keys back. Better to do it now than later.
Have you gone through that process yourself? I can't imagine you can just knock on your banker's door and say, here are the keys.
No, see, back in the day, you can't fill out because you're going to go foreclosure. You're going to go bankruptcy. You're going to fight him. I mean, I was one of those guys that actually spend in some cases 5 or 6 years fighting the bank. And finally, I learned in my leadership game book I talked about, I had to get aggressive with the bank and say, listen, the worst thing that can happen is for you to take it back. So if you take it back, you make no money. Depositors lose that. So what can you do? From that point forward, I learned stay under leverage. Don't have the money, don't invest in the project. If you're the tenants, don't walk into it because it's going to be a nightmare. So far now, over the last 20 years, no losses. And I try to maintain that because my thing is limit your leverage. Very important. They may give you 100% of financing. What good is it if you can't pay it back?
This is kind of goes opposite of what every real estate investing guru that has come on the show would typically tell you. Leverage is the key, and then that's how you scale as quickly as possible.
When times are good. See, now we're going to have times are going to be indifferent because that's one of the reasons why we have an election that took place like it did. People were just tired of the old, same old things not getting better. They go into the gas pump, they go into the grocery store, on and on. So the biggest expense they have now is either car payments and apartments, and rents aren't going down. I mean, we're not going to see rents go down below $2,000 or $3,000 in some places in the country. And as a matter of fact, the average rent is going to get $1,000. So if the average person is only making $35,000, $40,000, they don't have the income to maintain and sustain these kind of rents. So the bottom line of it is, as a real estate investor, it sounds good to borrow all the money, but the bottom line of it is, it comes out in the wash because can you maintain the portfolio like that when people can't pay? That's the problem. I mean, we're going to see that with storages. There's so many storage units that were built. What happens when people can't pay those storage fees? It's the same thing.
Yeah. And it seems like, you can't do this podcast for as long as I have without starting to see trends and waves of popular choices. At the time, like a couple of years ago, you're right. I mean, it seemed like everybody in the world was building more storage units. Now I'm seeing a huge influx of people dealing with and building flex.
Mm-hmm. Because see, here's the thing about it. I'm better known as an urban economist, right? And in that urban economist, I don't look at the economy as it is. I look around and see where people are. So if I'm going to a storage place and I'm looking at locks, double locks on the storage spaces, that means that people are not paying. If I'm seeing a bunch of red locks in multiple storage spaces that I go to, that's telling me something. If they're not paying to auction this stuff off, if I'm going to local newspapers, I'm seeing all these auctions of storages, that's telling me something else. If I'm going to the city courts and I'm seeing thousands upon thousands of people sitting in court, they don't have the money. What is that telling the investor? You're going to have to turn around and change how you're participating in this program. See, unless you're at the most extreme levels of wealth, you can't maintain that project. That's the problem. So that's why so many places here in New York and around the East Coast are now getting to keep that.
What do you think had gone right and what had gone wrong in the previous administration? And what do you foresee now with Trump back in office?
In the previous administration, and I'll go back, the trickle-down theory worked and it didn't work. It worked for people that were at the highest levels, and it didn't work for the people in the middle, okay? We got down to the Bush and the Clinton administration, both Bush Senior and Junior. Again, it was working for those at the highest levels and not so much for those in the middle. We get to the Obama years and extreme wealth was created. But in the same token, during the Bush and Obama years, there were people that were flourishing in the middle class and they were doing okay. So doing okay means you can do your vacation, you can have your car and so forth. Then we get to the Biden years, all of a sudden, all the things that happened over the last 25 or 30 years start hitting. All this debt and so forth, as well as the COVID situation started taking place. Now, can Mr. Trump basically back this up? I don't see it happening. He might reverse all the things that are happening, but the problem is going to be when you reverse things, there's turbulence. In that turbulence is where the problem is. How many people will take losses in a turbulence? Even some major investors are going to take hits. I mean, when you look at Blackstone, BlackRock, and some of the major companies, they're taking hits now because they're giving keys back to the investors, the banks and so forth. So the bottom line of it is, can he actually reverse this in 4 years? It's taking 40 to get here because we're at an all-time debt high. This country has never had $40+ trillion of debt. Never. No country has ever existed like that, all the way to and including Zimbabwe and Venezuela.
Well, and something to kind of tack on there is the concept that I think we hit another record on personal debt. Like the credit card debt on a consumer level is the highest it's ever been.
Right. So we've got what, 15, $16 trillion there. You have consumer debt to credit cards as well as car payments at an all-time high. The average car payment is $1,000. If a person's only making $30,000, as I emphasize, they got two payments, house and car. Now what? How do they eat? That's why you have this change in people's political policies. They're changing policies, not necessarily because of what they think about the candidate, but because they're hurting. So many people are hurting. So this is the problem. What happens when they can only pay rent and they can't pay for the car? So this is where the problem comes in. Something has to give. And I don't see where in 4 years you can reverse 40 years of politics, as well as the debt ratio, as well as the impact of what COVID is. That's the problem.
So do you think it's just an inevitable fact of life that we're going to see this huge adjustment and all we can do is do our best to prepare for it?
I would say to the average consumer and to the average real estate investor that's listening is batten the hatches, put your seatbelt on because we're in for a rocky ride. The next 4 years, the next 10 years, and possibly the next 20 or 30 years are going to be a long, rocky road, whether Republican or Democrat. The other part of the problem is that if you don't have cash sitting somewhere liquid, that's going to be a major problem. Because once you start reversing all these things, you put these tariffs on, foreign governments say, okay, you're going to put a tariff on me, I'm going to make the bill higher. Well, okay, if you're already hurting now from car payments and house payments, what happens when you can't buy the milk at $9? When you can't get basic gasoline? I mean, something's got to give. So I'm saying if the stock market actually tanks down to say 65, 75%, that cleans that out. But we still haven't cleaned the governmental debt. The governmental debt itself is still $45, $50 trillion in counting. That's going to take another 10 years to clean out. We're in the grandkids. So we have a major problem here. It's either a lot of cutbacks have to take place and a lot of changes have to take place on policies, not just the ones that have been extracted.
Just to remind everybody, if you're interested in what Darius has to say, check out his book. He's got another one coming out actually as well, but the current one is Leadership DNA. Take a look and find that, as well as his website. Head over to dariusaross.com. If you found some value in what we're talking about so far, do us a quick favor, share this with one of your investor friends. And if you're watching us on YouTube, give us a quick like and subscribe. So Darius, anytime that there is turmoil like this, somebody's going to come out ahead. Somebody's going to make a lot of money. How do we position ourselves so we can possibly take advantage of this?
We're going to go in a little bit of a 3 or 4 minute tirade here. What we're going to have here during his time period will be 2 or 3 years of nightmare where this restructuring is taking place. 10 years of turbulence, 30 years of a renter's market, because those that are able to be investors, we're going to be in a renter's market for at least 30 years because baby boomers, millennials, and the Zers, and even the alpha generation, as well as the beta generation now, will be 30 to 50 years of investors. Now, here's the trick. We're going to see for the first time billionaires, trillionaires, to quadrillionaires. There's a new one. Because what's going to happen now is within this global economy, we're not looking at local economy, it's global. Africa is going to have about 10 billion people in it. India is going to have about 3 to 4 billion. China is going to start repopulating again, so 2 to 3 billion. So within that in mind, we're looking at the millionaire population, the multimillionaire population. The billionaires are probably numbered 10,000 or more. There's probably going to be about 1,000 plus trillionaires and at least 100 quadrillionaires based upon building, construction projects, real estate, multifamily, industrial, and so forth. So there's going to be a ton of money to be made on the opposite side of the coin. But you have to be positioned in a situation where, financially speaking, you're not leveraged, you're not in debt, and you're positioned with your creditors or your investors where you can basically play in the backyard and do well. You can't be over-leveraged. Now, the key markets that are in the country right now that'll be popular for the next probably 5, maybe 10 years: Chicago, St. Louis, Minneapolis, Dallas, Milwaukee, Memphis, Charlotte, as well as Miami. Those are going to be the key markets over the next 45, 30 years. Because people are going to be flooding in.
Okay. So you continue to mention don't be over leveraged, but if you're a small investor trying to get your foot in the door and trying to ramp up to the size of being included in this, like where does somebody like that start?
You're going to have to start with probably credit cards. I'm sure you're going to be taking loans out, but be in a position where you don't put yourself where you have to take these extravagant things you're buying. Leave that for later once you're in a position to do that. Focus on reinvesting in your business. Focus on keeping that property up to snuff. Focus on making sure that property can turn around and appraise out of the better position. And you can use that aftermarket value. You can use that loan value, because remember, interest and taking money out of a property is basically tax-free person if you're taking the debt out. So basically, if you could turn around and use that debt as leverage and continue to keep that going, but still making the payments and making moderate payments and not getting crazy in debt, you're okay. See, I'm all for debt. Wisdom in the debt, being wise with it. You know, if you're taking out $500,000 on a property and you can't afford to pay the $500,000 because you don't have the tenants in there, that makes no sense. But if you can do that, the tenants are in there, they can appraise out for $750, you can take out another investing in the property. You're okay. Just be wise. Patience.
Sure. Well, now that you properly scared everybody, are you suggesting that they even might hold off on buying their first personal property, like for their home living?
It depends on the market that they're buying in. You want to buy in markets where people are not buying, which means those are going to be areas that are not necessarily the greatest of areas. I'll be very honest. I just bought a property not too long ago in Calais, Maine, and I bought the property for 58 and sold it for 155. For that gives you an idea. But it wasn't the market of choice per se. It was like, yeah, I'll work with this. So that's what I'm saying. Some form of strategy is important.
So something that caught my ear earlier is that you said that BlackRock and some of these big companies are starting to hand back keys already. Is that because they over leveraged in that situation?
It's because they realize it's not worth their overall mission statement to continue holding on to the property. None of them taking losses. You know, those partners, general partners, limited partners aren't taking losses. That's what the bottom line. Their whole time is 7 years. They get to that 7th year, this property is not making anything happen. They're out. They're not going to waste time.
So would you suggest that some people who are thinking about getting into investing should review and consider getting involved in syndications or some bigger outfits that can take down bigger deals?
I would say either way it goes, be very cautious and careful when you're using the money that you have harder saved and so forth, whether it's in syndications, big outfits, or however you're going to do it. Focus on what your tolerance ratio is. You know, I steered clear of certain type of situations because my tolerance ratio was that I'm a conservative investor. Not that I don't do leverage, but like in this particular case, when I saw that this particular property was not fitting my purposes, I was out. Now I saw a couple of guys that are trying to get out of the town and they haven't been able to sell out of the town. But my thing was, I'd rather be, as the curve is going up, get out about 3/4 of the way up or 2/3 of the way up versus at the top of the curves. You get that. Get out when you can versus when you think, yeah, we're at the top of the hill.
So let's say somebody is getting into this and, a lot of people are trying to get into something more passively to get involved in some sort of multifamily. some of these large syndicators, they're over leveraged in many aspects too. Is there any kind of red flags that somebody should be aware of before they get involved in something like that?
Take a look at the properties that they're positioning you to actually get involved in. I mean, they should give you a list of properties that are on the table and what your potential money is going to go into. Drive by it. Make it very simple. Drive by, take a look. Shopping center, it's the RIT that has X amount of properties. If it's a local retail strip center, if you see 4 or 5 of those stores that aren't there, that means your money's not going to be there. If you're going in the neighborhood and some major investor is saying, okay, I'm going to buy up this area, that's fine. But are people actually living? That's why I call myself an urban economist. I go into the urban inner city and see what people are doing. If they're not doing what needs to be done and I'm on the ground, then I don't care what you're telling me on Park Avenue or Wall Street. I'm on the ground seeing it. If these grocery stores are vacant, if these shopping strips are vacant, if these retail centers are vacant, does my money need to go there? Probably not.
You mentioned like you threw Minneapolis into the list of
Mhm.
hot areas in which to consider. I actually live in Minnesota.
Mhm.
So that is one of those areas. Well, in its current state, that downtown Minneapolis area is still recovering from some very bad riots and other things. And I haven't seen a ton of investor activity in those areas quite yet. Do you think that's going to change?
Absolutely. I would say in the next 4 or 5 years. The reason being is because Minneapolis is one of those cities that is positioned in the right place at the right time. There's nothing else around it. Duluth is too cold and people just don't want to go to Duluth and it's too cold. Minneapolis is ideal. I mean, it's a perfect place for perfect opportunity to come there. Adjacent to that is Milwaukee. Same thing. These places are kind of ideal to be the center of the state and everything. All the activity is there. They have everything that they need there. But they will come back. It just takes a little time. That's why I say the horizon for Minneapolis and like all these other cities is 5 to 10 years. You have to be patient.
Do you think that's going to be part of it is going to be the price adjustments that we're going to be going through?
Because here's the key. As an investor, if I'm looking at the price of properties down by 50%, I'll take your gains. What I have to lose is 50% off. Like I said, I bought that house at $58,000. There was nothing to lose. The bank was sitting on it. The bank had lost out. They were walking away. So why not I get in there? I made out. The bank couldn't make it happen because they didn't want to put the money in there. But the key thing of it is, if you're willing to take a little bit of time and patience, you can be okay. But again, it's not a quick kill. Real estate is a business that is time-based. It may take you 5 or 10 years in the market. Can you maintain that more? That's the question.
Making this, you're making this upcoming market sound like a big discount warehouse. You're just going to be able to go in and have your pick at 50% off.
We go back to what Resolution Trust was in the 19th. For people that aren't familiar with that, Resolution Trust is when the banks all went under. And there were a lot of millionaires and billionaires that were made during that time period. Now, within that in mind, there were properties that were just being given away. Radio stations, TV stations, you name it, was being given away because all the SNLs disappear. Same thing will happen here. If the banks have to take a loss and they have to take these places back, this is what's going to happen. Because banks are in the real estate business. They're in the lending business. So you're going to see this. But the problem again is, do you have the resources to remarket the property and reposition it? What good is a vacant, abandoned building if you can't reposition it for people to live in? We don't have a lack of people willing to pay. We have people unable to pay what you're asking. So investors have to be realistic. Like, for example, I did in some cases cut rents by 40, 50%, but I wasn't leveraged. So, okay, if I'm only paying, say, $10,000 on a property and the rent's coming in and maybe $15,000, yeah, not such a great margin, but I'll pay. Versus I need 40,000 and I got to get up 80,000.
Well, Darius, this has been a fantastic and insightful conversation. Before we jump into the rapid fire questions, is there any thought or concept you think we should have tried to touch on to here today?
I think the big thing of it is making sure that the average investor, whether professional, seasoned, or institutional, understands that this market is the market of a lifetime that's going to change people's lifetimes. Some people will lose their ass and some people will come out of this smiling all the way to the bank. It's just a matter of how you look at it. Perception is everything.
Well, Darius, if you're ready, we'll jump into the rapid fire questions and close
Sure.
out this episode. First, what lie do real estate investors tell themselves?
I'm going to be rich overnight.
Yeah, that's a pretty common one. I mean, I remember late night TV, those infomercials promising me mailbox money, and it was going to be so easy.
Uh-huh. So you did your first deal.
If you could go back in time and give your younger self a piece of advice, what would it be?
Rehab is a very dangerous thing if you don't understand anything about real estate. The price of products, the price when you go to Home Depot versus Lowe's, the price of anything. And if you don't know how to fix it yourself,
Do you have a book recommendation?
right now, recently has been 50 Laws of Power, as I'm going back over it again. And, he says a lot of interesting things there that are valid in Sun Tzu.
And then lastly, what single strategy or tool have you implemented that has had the biggest time-saving impact to you or your business?
Understanding how to create teams. You are a product of who you put on your team. Very simple, very basic. The reason why Mr. Trump is in the White House right now was how he created his team. The first time out, it was kind of helter-skelter. This time, tight-knit, woven, smooth. You have to create the right teams, right people, loyalty, consistency. They have a reason, they have a purpose, and they have, I call the gorilla mentality. They're going to roll with you. You're good.
Yeah, like you mentioned, you're on Darius, the correct site. If you see the rhino on Darius's website, then you kind of alluded you gotta be able to run through everything. You mentioned the cohesiveness of Trump's team. That is something else, I noticed this time around. There seems to be something else there, and you if it's going to be as turbulent as you suggest, he's going to have a very loyal, strong team behind him.
Because the key thing with that is you have to have people that are going to be in the room and like what's happened recently. He's been told to understand how not to be the smartest person in the room, how to be quiet, how to be efficient to listen to what people are saying to you, how to listen to young Barron, how to listen to young Donald, and think to yourself, I don't know everything. I'm willing to be the studious person in the room in order to win. Because it's not about being smarter, it's about being wiser. And wisdom wins every time.
DariusARoss.com. You can find more information there, but really appreciate your time, Darius. This has been fantastic.
Thank you, Sauce. I appreciate it.